So this one is about the trading setup, the take profit, the stop loss, trailing stop, and the position size, right? So let's begin. First of all, again, we remember that we have the zone, which can be a demand zone or supply zone. In this case, let's say it's a demand zone. First of all, our entry, okay, should be on the upper side of the demand zone, which could be somewhere around here whenever the market crashes and reaches our entry point, which can be here, okay? Here is gonna be our entry level long position, and the position size, we have to calculate that if, for example, from here to here, not risk more than 1%. Remember, 1% is the percent that you can leave the position open and you can go to sleep. And I mean sleep, not stay all night up and see what's going on. Because 1% psychologically is okay to sleep. Otherwise, you are not going to sleep. You are going to lose your sleep, your wellness, everything, your health. So remember 1%. So risking 1%, we have two options here. First option is the take profit, which whenever it goes up, let's say this is 100 points, pips, whatever you are calling. The way I approach it is the following. Whenever the price goes up to 70% of this run, I take profit, okay, 50% of my capital, of the investment I placed, so the trade. And then after, I move my stop loss, which should be here, all the way up here to break even, maybe 1 or 2 points higher, so we not lose any money. And we create a trailing stop, meaning that as soon as the market starts going up, the stop automatically goes up as well. Maybe it can do a huge spike all the way up, so the stop is gonna go as well here. And as soon as it goes back here, let's say, the position closes. And that's the beauty of the trailing stop, because the stop is moving automatically upside, downside, in the same pattern or way as the market moves up or down. That's super important. So remember that the take profit, we take profit at 70% of the initial run, then the other 50%, we are gonna leave it go as much as it goes, okay? Second thing is the stop loss. Remember to put the stop loss a bit lower. Let's say if the market is here, I always put it, for example, visually, just a small, a bit down. So in case it's a huge spike ups and downs, it doesn't get closed, the trade. The stop loss is this. Basically, as soon as we go up, close on 70%, we move to stop loss. You can move it even sooner if you want, but I like to wait until it reaches the 70%. Then after, I move the stop loss. Then after, I let it go as long as it can go. But here is the catch. Just think that this case, leaving it will be on the smaller time frames, which is the continuation pattern, is not the reversal pattern, because with the reversal pattern, as soon as the 70% on the bigger time frames, as soon as the 70% reaches, I'm out. I mean, I close 100% of the trade and I'm done. Why? Because most probably it can go down, can happen lots of things that you cannot control. But on the continuation pattern, things change. It's much easier to do. So remember, 70%, 50% out, profit, and let it run as much as it can. Always put the stop loss. Never ever, I repeat, never ever cancel that stop loss. Move that stop loss or whatever you are thinking. Never touch it. It's better to have 1% loss than start looking how the loss starts going to 100, 200, 300%. You can go to the Binance Square everywhere you want, and you see that people are waiting 500, 600% minus. What the hell are they thinking? I don't want to understand that. That's why 1% is always better than leaving that big. And the position size, again, try to make it 1%. When the perfect timing and when all the stars align together and you see that, wow, trade, I put 5% risk. But that can be once a month. And well, that's how I do it. But if you want to sleep well, just put 1%. Got it? Thank you.